Hi, everybody. Welcome to our second quarter 2021 market update, as well as a special guest today. We have Dave Leibowitz from JP Morgan, who will be also talking about our cryptocurrency, state of the markets, and give us some really valuable educational session as to cryptocurrency, what it is, what it's not, and how to maybe include it in portfolios or how to think about it. Some pros and cons, as we like to present here at Tobias Financial Advisors. My name is Matt Sainholtz. I'm the Chief Investment Officer, as well as a Senior Financial Planner here. And before we get started into the presentation, I do have to just go through a couple of housekeeping items. Today's presentation is educational in nature. All the items discussed here is meant to inform you, and anything that you need to make decisions on regarding your own personal situation, please contact one of our advisors, and we will be happy to discuss your life circumstances, how you play, how cryptocurrency might play in your portfolio, as well as just the markets in general. So it's in general in nature. Also, on your webinar functionality, there should be a place to enter in questions. We hope to have a few minutes for questions at the end of the presentation. We'll try to do our best to get to them all. If they do line up and have too many, we'll try to address it after the fact. But please do use that functionality to address any questions you might have for me or David. Who we are, Tobias Financial Advisors. We are a fee-only financial advisory firm located in Plantation, Florida, just outside of Fort Lauderdale. We were founded in 1980, and today we're managing over $600 million of assets for mostly high net worth individuals, some 401k plans, profit sharing plans, and small business owners. We value education, which is why we try to put on these presentations. We have certified financial planners on our team, certified public accountants, CPAs, and CFAs, chartered financial analysts. So we really value education and hope to continue that today while we dive into some of our topics. Generally, our investment philosophy is own the markets worldwide. We know that we cannot control everything that goes on inside the world, inside your own lives. So we kind of need to control what we can control. We want to diversify globally, watch out for the tax man, lower your cost of investing, and really generate a portfolio that's built for you. It's built to achieve your goals and your life circumstances. So that's what we're trying to achieve. And that is really a high level look as what we're trying to accomplish when we're thinking about investing your hard-earned funds. Quick update today on the second quarter market results, and then we're going to dive right into our discussion with our guest. So second quarter 2021, all 6 green arrows on the screen here. We like to see that. U.S. stocks worldwide, and even bond funds were all positive in the second quarter of 2021. And what has happened is the recovery from the pandemic, the back to work, the global reopening of the global economy continues to play out. And we've seen several of that positive news come into our from corporations and from the economy in general. Last quarter, we saw unemployment dip below 6%. Plenty of job openings out there, but that is positive news. And another part of the equation is we're starting to see some inflation creep into the equation. Maybe a good news if you are on Social Security and you might get a nice big raise at the end of the year, but also some inflation is good and some is not, and we can dive into that a bit further. But as long as it's in check, not runaway inflation, as some of you may remember is from the 1970s, we think it's a good thing and an overall positive for the markets. U.S. stocks, again, account for 58% of the global stock market capitalization, so obviously a very big component of our portfolios. Year to date, S&P 500 at this time, as of June 30th, somewhere around up 13% at that time. Value stocks year to date, that part of the market has returned well. But in the second quarter, the growth stocks, some of the technology stocks did come back during that time frame. So, but overall, generally positive. Small caps actually outpacing the larger companies as of year to date, June 30th. And, we are overall having a good year. When we think about what we preach, diversification, you can kind of see here on any one of these charts, you can kind of see the effects of being diversified. And really that's what we try to do with our clients, is try to figure out where they are in life, what they're trying to achieve, how much risk they really need to take or want to take within their portfolio. Just have to be careful with all excess cash, T-bills or the bank account's not paying you anything. And so we want to figure out a way to balance the need for capital growth with capital preservation. And over the long term, a balanced portfolio over the last 10 years, an average portfolio is averaging 6-7% a year over the last 10 years. And pretty much that's what we're trying to achieve when we are managing assets for our clients. And that is just a simple illustration of the idea of diversification and the idea of managing your risk and managing your rewards at the same time over the long term. So without further ado, I'd like to introduce our guest speaker today, David Leibowitz. He is the global market strategist at JP Morgan Asset Management, and has been quoted on Bloomberg TV, CNBC, and we're really lucky to have David here today to share his insights. Just a really brilliant guy, and we're happy to have him here. So David, I'm gonna flip to our first screen and welcome you, and so take it away.
All right, great, thank you, and good afternoon, everybody. I hope you're all doing well. So in terms of the roadmap for today, I want to start by just talking a little bit about what cryptocurrency is, why we think it's garnering so much attention, and really some of the underlying technology, primarily blockchain, that these assets are built upon. Then I want to shift gears. I want to talk a little bit about the growth and the adoption of crypto that we've seen over the course of the past, call it decade or so, and then conclude with a few thoughts around how you can fit crypto into a traditional diversified portfolio, some of the environmental concerns that go hand in hand with allocating to these assets, and then most importantly, where we may be going from here. And so if we dive right in on the next chart, just taking stock of, really why people have been so focused on these crypto assets over the course of the past couple of years, it's because you can't ignore charts like the one on the screen in front of you. And what we're showing here is the price of Bitcoin back to 2010. A lot of people, when I talk to them about Bitcoin and crypto broadly, they say to me, it's a bubble. And, look, I have a 2-year-old daughter. She loves to play with bubbles. And when the bubbles pop, they don't reinflate. And I think what's so interesting about crypto, and you can see it over on the right-hand side of this chart, is that has it been very volatile? Yes. Have there been ups and downs and sideways moves? Yes. But, the bubble didn't pop and then subsequently the price went to zero, right? There's been a resiliency in these assets, not just Bitcoin, but in crypto more broadly, that really suggests to me, these things are going to be around for the foreseeable future. And I would argue that the growth and the evolution of the digital asset universe more broadly is something that I think is going to characterize, not just this cycle, but many cycles into the future. And so, a lot of people, they look at this chart and they say, "Wow, it's so scary. This is like, tulips back in the Netherlands." I don't really buy it. The resiliency, again, as illustrated by the price, suggests to me that these assets probably have a bit more staying power than some folks currently expect. But if we flip to the next chart and think a little bit about the technology that these crypto assets are based on, I'm sure that everybody on this call has been out to lunch, out to dinner, at a cocktail party, and the topic of cryptocurrency has come up, and somebody in the room who thinks that they're the smart one has said, well, it's really all about the blockchain, right? It's not about the assets themselves. The value is in the underlying blockchain technology. And I would say that that's most likely true, but I think that a lot of people don't understand exactly what a blockchain is. And so, fundamentally speaking, a blockchain is just a database, and a database is a collection of information that is stored electronically. The biggest difference between a blockchain and a traditional database is effectively the way that the data is structured. And so you think about a traditional database, think about a sheet in Microsoft Excel, right? You have rows, you have columns. That's the way that you're going to structure the data in a traditional database. In a blockchain, hence the name, the data is structured into blocks. And so, at the simplest level, all blockchains are databases, but not all databases are blockchains. And currently, you're seeing blockchains be used to store primarily cryptocurrency transactions, but the reality is that the real world use case for this technology is far broader than tracking people buying and selling things with Bitcoin. It can be used to store medical records. It can be used to store voting records. It can be used to assist with things like trade finance, which right now is an incredibly muddled process that the banks are the primary players in. And so there are lots of real world uses for this blockchain technology, and that's something that we think is going to evolve here going forward. But basically the way that this works is a new transaction gets entered into the system, right, into the universe of computers that are running a certain code. And let's just say that, I want to buy something from my friend Tim, and I'm going to pay Tim for this using Bitcoin. So we enter this transaction into the universe, and then the transaction is sent to all of the computers within this universe, and they all try to solve a very complicated mathematical equation to determine the validity of the transaction. And this is something called proof of work, where effectively 51% of the computers in the network that are running, in this case, the Bitcoin code, just as an example, need to say, okay, this is the answer to the equation that we've been asked to solve. And once that has been done, the transaction has been verified. Now, what these miners do, and that's probably a term that some of you have heard, and these are the people that are verifying transactions and creating the blocks, they take all of these legitimate transactions, they cluster them into blocks, and then the blocks are chained together, hence the term blockchain. So when you think about it like that, it hopefully becomes increasingly clear in terms of how the blockchain is used to verify these transactions and how the blocks are actually created. I'm going to talk a little bit more about what this means in the context of Bitcoin specifically in just a couple of minutes. But before I do, if we jump to the next chart, I think it's important to understand the way cryptocurrencies differ from traditional fiat currencies. Now, I personally don't like the term cryptocurrency because I'm an economist by training. And so to me, a currency is something, it's a store of value. It's something that can be easily exchanged for goods and services. And, as I'll kind of illustrate in just a couple of minutes, I'm not sure that things like Bitcoin necessarily check all of those boxes. But, before we get there, let's just start with the very simple question of who manages these currencies and these digital assets. Well, on the crypto side, the currency, the assets are managed by the network of computers that are running a given source code. And that can be the source code for Bitcoin, it can be the source code for Ethereum, right? Lots of different options there. Traditional fiat currency, well, it's managed by the government that issues it. And the way that it holds value is relatively similar. The way a traditional currency holds value is really based on confidence in the issuer. We talk about dollars being backed by the full faith and credit of the US government. The way that a crypto asset holds its value, well, as we've seen over the past couple of months, that is purely based on the forces of supply and demand. In terms of the way that it's secured, crypto assets are secured by the network of computers that are verifying every transaction. Traditional currency secured by things like banks and governments. When I go to pay my mortgage every month, I do so through my Chase account, and that makes sure that the lender gets what they need in a timely fashion, right? When it comes to Bitcoin and other crypto assets, that transaction is being verified and kind of, the transaction itself is occurring within the context of the network of computers that are running this given code. The next one's pretty straightforward. Are there physical bills or coins? Hence the digital asset theme here. Crypto assets are purely digital. Not a lot of people I know still use, actual paper currency, US dollars and euros and things like that, but they do still exist. And that's another difference there as well. And then finally, can I buy things with it? So I understand that you can buy things using Bitcoin, but the reality of the situation is that I cannot go downtown where I live in Connecticut and buy a cup of coffee using Bitcoin, at least not yet. And so until, I can exchange these assets easily and readily for goods and services, to me, they're not really currencies. Again, they're assets, and there are obviously a number of things that differentiate them from traditional fiat currency. But to me, the big issue, the elephant in the room, is one's ability to transact with them in the course of their day-to-day activities. Now, if we jump to the next chart here, we've talked a little bit about blockchain itself. We talked a little bit about the way traditional currency differs from crypto assets like Bitcoin. So what is Bitcoin specifically? Well, let's start with the ecosystem. And we've talked about this a number of times thus far, right? Basically, there is a network of computers out there that are all running the Bitcoin code. And all of those computers together store the transaction history, right? Store the blockchain. So if you were to look at the Bitcoin blockchain, it would include every transaction that has ever occurred using Bitcoin. Now, how do people keep their Bitcoin? I'm sure a lot of you have heard about things like Coinbase and other kind of digital asset wallets. Balances of Bitcoin are effectively kept using keys. And there are two different types of keys. There are public keys and there are private keys. Public keys are like bank account numbers. Private keys are like ATM pins. So let's go back to the transaction that I'm conducting with my friend Tim, where I'm buying something from him and paying him in Bitcoin. I need to know his public key so that I can ensure that the funds are sent to the right place. And then Tim is going to use his private key in order to unlock that account and be able to take his Bitcoin and convert it into US dollars if he deems that that's the most appropriate course of action. How is new Bitcoin released into circulation? Well, it's released through a process called mining. And we talked a little bit about this earlier, but effectively mining is when computers solve these very complicated equations, verify the underlying transactions, and then cluster those transactions together to create a new block that is then added to the blockchain. And depending on the size of the transaction, a block can have 2 transactions, a block can have 100 transactions, right? But a block tends to be about 1.5 megabytes in size, and again, on average, contains, call it 30 to 50 transactions. So miners go through this process of verifying transactions, adding blocks to the blockchain, and they're rewarded for doing so, which is why you've seen so much growth in the mining industry over the past couple of years. However, that reward is halved for every 210,000 blocks that are mined. And so right now you get rewarded with 6.25 Bitcoin for every block that you add to the blockchain. The most recent halving was on May 11th of next year. And when that next halving occurs, right, you'll end up getting paid, what would it be, 3 1/12 or 3 1/8 Bitcoin for each block that you add to the blockchain. And there will only ever be 21 million Bitcoin. Right. And so this is where a lot of people begin to talk about, well, it's a form of digital gold. As I'll illustrate in just a couple of minutes, I think that is a little bit of a misdrawn conclusion. And then finally, so how do you get your money out? Right. So most of us aren't miners. I'm not sitting here in Connecticut trying to verify transactions and add blocks to the blockchain. But, let's say I own some crypto and I want to convert it into US dollars. It's not as simple as me walking up to the Forex window at JFK and saying, here's my Bitcoin, give me dollars or give me euro or give me yen. What I first need to do is convert my Bitcoin into stablecoin, right? And stablecoins are kind of like money market funds. The coins are backed one for one by actual dollars, actual euros, actual fiat currency. And so the first step is you convert your crypto into a stable coin. The second step is you convert that stable coin into traditional, dollars, euro, yen, Swiss francs, so on and so forth. And so one of the challenges is if there are a lot of transactions that are trying to be verified at any given point in time, right, the system can get bogged down. And not only do transaction times increase, but transaction fees can increase as well. And so it's important to recognize that these assets are not necessarily as liquid as things like traditional stocks and bonds. Now, if we flip to the next chart here and just think a little bit about the growth and adoption that we've seen of crypto over time, to me, the chart on the left-hand side is just absolutely spectacular. I mean, Jeff Bezos, he did it. He went to space this morning before I had 3 cups of coffee, but it took him 24 years to grow Amazon into a $1 trillion company, right? Although the market cap of Bitcoin has come in over the course of the past couple of months, it only took 12 years. It took half as much time for Bitcoin to hit $1 trillion in value as it took for Amazon to accomplish that same feat. And you look at companies like Apple and Microsoft, right, and it took them even longer. And so the speed of the growth that we've seen is certainly something that has been quite impressive. And the adoption of crypto continues to grow. You look at the chart on the right-hand side, the number of blockchain wallet users worldwide. This is an estimate from our friends at Deutsche Bank. You can see that at the end of last year, Deutsche Bank estimated that there were 63 million blockchain wallet users around the world, with that number effectively having doubled since 2018. And so, the growth and whether you think about growth in terms of the total value of these assets or the number of people transacting in these assets, right, the growth here has been pretty spectacular. And I think that the first chart we looked at is a big part of the reason why. Now, if we jump to the next slide, I want to talk a little bit about recent performance and then how we think about crypto within the context of a portfolio. What I've done on this chart is looked at the year-over-year growth in the money supply, which is the light blue line, and then the price of Bitcoin, which is the gray line. And you can see that to an extent, the rise in Bitcoin prices that we saw into the end of 2020 and the beginning of 2021 was to an extent a function of excess liquidity. I mean, I don't think I'm telling anybody on this call something new when I say there has been a lot of money pumped into the economy and the markets over the course of the past 12 to 15 months. And that's effectively created an environment where there is too much money chasing too few assets. And so you've seen people chase the price of things like Bitcoin, but as money supply growth has declined here as of late, or slowed here as of late, you can also see that some of the wind has come out of the proverbial sails. And so I don't want to confuse correlation with causality, but I do think that part of the big run we saw in Bitcoin earlier this year was due to money being pumped in to both the global economy as well as the global capital markets. But if we flip to the next chart, so how does this all come together within the context of a portfolio? And a lot of people say to me, well, Bitcoin is a diversifier, right? It moves independently from the stocks and bonds that I own. And I think what's interesting is if you look at this chart, and what we're showing here is the correlation over the past 10 years of a variety of different assets. And you can see over on the far right-hand side, Bitcoin effectively appears to be uncorrelated with all of these assets over the 10-year window. Yes, it's had annualized volatility of more than 250%, and we'll talk about that in more detail here in just a couple of minutes. But at the surface, right, when you look over a 10-year window, one might believe that Bitcoin is an effective diversifier relative to traditional stocks and bonds. But this masks something very important that occurs during that 10-year window. And if we flip to the next chart, what you see is that these correlations are actually very unstable over time. And so what we did here on this chart was we looked at a rolling correlation between Bitcoin and stocks, which is the green line, and Bitcoin and inflation expectations, which is the blue line. You can see that sometimes Bitcoin moves with the equity market, sometimes it moves the other way. Sometimes it moves with inflation expectations, sometimes it moves in the opposite direction. And so we said, well, this kind of suggests to us that there isn't really a clear-cut relationship here. So maybe it's a little bit cleaner when we look at the relationship between Bitcoin and more defensive assets. So if we flip to the next chart, what we've done on this slide is conducted the same analysis, but looked at the relationship between Bitcoin and high quality fixed income, which is the gray line, and then Bitcoin and gold, which is the purple line. And for all those people who tell me it's digital gold, well, it doesn't really act like gold all that often. And you can see sometimes it's correlated with high quality fixed income, sometimes it's not. Same is true with gold. The bottom line is that these correlations, they fluctuate so tremendously over very short periods of time in some cases, and that makes it very difficult to set a reasonable expectation for how these assets will interact with the other parts of your portfolio. And just to get a little bit geeky here for a second, if you think about modern portfolio theory and you think about the way that people think about optimizing portfolios, basically what you do is you say, okay, I think that this is going to be the return of an asset. I think this is going to be the volatility of the asset. And I think this is how the asset is going to interact with the other pieces in my portfolio. And you feed that into an optimizer and it spits out a recommended allocation. The reality is, as we saw, the return, I have no idea what the return of Bitcoin is going to be over the next 12 months because the price is purely determined by supply and demand. Very difficult for me to build an expectation around how Bitcoin is going to interact with the other pieces of my portfolio, given the instability of these correlations over the course of the past 10 years. And then flipping to the next chart, thinking about the volatility portion, yes, volatility has come in relative to where it was back in 2013 and 2014, but it is still multiples higher than what we see in the S&P 500. And again, not necessarily, if you look at the gray line relative to the green line, it is far more squiggly than what we see for the S&P 500. And so it's very difficult to figure out what the volatility is going to look like, very difficult to build realistic expectations around return. And then again, the way that it interacts with other parts of your portfolio really changes on a day-to-day and a week-to-week basis. And so if we flip to the next chart here and just think a little bit about the environmental impact of all of this. So hopefully it's become clear some of the challenges that exist when it comes to determining the optimal allocation to Bitcoin within one's portfolio. And I just want to share one quick kind of funny story example that I think sheds even more light on this. So our investment bank said, you know what, like this is crazy. We can't figure out what the return is going to be, can't figure out what the volatility is going to be, we can't figure out what the correlation is going to be. So let's just use historical data, right? Let's use the average over the past 3 years, the average over the past 5 years, and the average over the past 10 years, right? Purely historical averages. The recommended allocation to these assets, depending on the look back window, ranged from 5% to 1%. Right? So it's a very difficult exercise figuring out what that optimal allocation is. And at the same time, as we see things like ESG and sustainable investing gain a lot of momentum in the current environment, another kind of rub that comes with investing in crypto is the energy consumption, the environmental impact that you see from mining all of these assets. And what we did here was we looked at annual energy consumption by country, and then included Bitcoin there, which is the green bar. You can see that in 2019, mining Bitcoin consumed more energy than the entire country of the Netherlands. Right? Just think about that for a second. It's absolutely spectacular and not necessarily in a good way, but there is light at the end of the tunnel. The proof of work process, the getting the computers, 51% of the computers to verify the transaction is a very energy intensive process. And I actually saw an article the other day talking about the crackdown on mining in places like China and other parts of Southeast Asia. And literally they were driving a steamroller over these computers, over these mining computers, partially because of the negative environmental impact. But there's a new way to verify transactions that's gaining a lot of momentum, and that's called proof of stake. So rather than having to have 51% of the computers in the network verify the transaction, effectively a single party gets chosen to verify the transaction based on their stake in the network. And so that stake is oftentimes determined by the amount of crypto that they've mined or the amount of crypto that they hold. Think about this in the sense of traditional banking, right? If people want to verify a transaction, so when I pay my bills every month, right, I can go on my Chase app and I can select who I want to pay and I hit go and the bank sends that person, the money electronically. JP Morgan JP Morgan Chase oversees that transaction because they're one of the biggest banks in the country, and people trust them, right? That's the way proof of stake works. You would have these verifiers that have a good track record, that have a stake in the network, and they would be responsible for verifying the transaction rather than 51% of the network. And so it very much seems that that is the direction of travel for these assets. That's really what the Ether and Ethereum tends to be based more on proof of stake as opposed to proof of work. But if we flip to the next slide, just to wrap up my prepared remarks, it's very clear to me that these assets are here to stay. And the smartest thing anybody has said to me about crypto over the past couple of months is that you can use it in a speculative manner. Sure, you can use it as a bit of a hedge, but you need to be prepared for it to go to zero. That's not me saying it will go to zero, but that's the type of risk that still exists in these markets. But I don't think it's going away anytime soon. You look at the Google Trends data over there on the left, right? Peak popularity in terms of searches for the term Bitcoin. You look at the chart on the right-hand side, looking at the share of different populations that have bought or sold cryptocurrency. And, in the developed world, particularly amongst the 18 to 34 group, you see relatively decent adoption. And so, I think we need to be thoughtful about where the puck is headed, rather than where it is today. And to me, these are not a silver bullet. These aren't going to address, crypto assets aren't going to address some of the bigger picture issues that we all face as investors in terms of expected returns, the level of rates, and the potential impact of inflation. But I do not believe that these assets are going to disappear anytime soon. And so we're continuing to do more and more work on this at JP Morgan. I actually am part of a group that spans the entire bank, and we get together every other week to share what we've been hearing, seeing, so on and so forth about crypto. And so you're seeing a lot of momentum in this industry, and I think that that's a testament to the fact that it is likely here to stay, but it is still a very complicated topic and a very complicated technology. And so with all that said, I'd like to thank you very much for your attention today, and I'd be more than happy to answer any questions in the time that we have remaining.
Wow, thanks, David. That's very informative, and we can't thank you enough for joining us today. And just to add a little color as to how Tobias Financial Advisors thinks about cryptocurrency is you nailed it right on the head. As far as it's just a little too early, and it's a pretty speculative. We don't think it's going to go anywhere. It's kind of like reminds us of the early days of the internet, where you had a lot of websites out there, and we didn't know exactly which ones were going to be winners. And there's literally for our clients and folks that are listening today, there's literally, we talked about Bitcoin. I think David mentioned maybe one other cryptocurrency in his presentation, but there's literally hundreds of them. And so which one's going to be the winner? Which one's going to be the losers? Which ones are here to stay? It's a little too early for us to get behind as far as investing your hard-earned dollars, but it's something that we're going to keep our thoughts on and continue to work with David and his team and hear and our ears to the ground as to what's going to come next. And so the answer for us is not right now. Maybe 12 months from now, we might have a different presentation to provide, but just the fact that it's not creating any sort of, doesn't pay you a dividend. There's no real economic value here yet. Makes us push the caution pedal when we are thinking about our portfolios. But David, we have a couple questions coming in here. What are your thoughts, or what do you hear about, like, why doesn't just the United States come up with a crypto dollar? And that would be kind of moving finance into the 21st century.
So, I mean, there are active conversations about implementing a digital dollar. You obviously saw China, kind of get out on the front foot on that and issue a digital renminbi. Part of what people like about crypto and things like Bitcoin is the decentralized nature of the network, right? So it's very anonymous. And in a world where populism is still around, and frankly, a lot of people are very frustrated with their local incumbent governments, there's value in certain people's eyes to basically operating off the proverbial grid. And so they're working on a digital dollar at the Fed. It's called Fed Now, and it's a program that's been in place for the better part of the past couple of years. I do think that we will see a digital dollar and a digital euro and so on and so forth over time. But those are going to be centralized, right? And it's going to be, everybody's going to see who's transacting and what they're transacting for. The anonymous, decentralized nature of the crypto universe, I think, is what makes it appealing to certain individuals.
Thank you for that. Yeah, that makes a lot of sense. The whole benefit of it being not tied to a government is one of the main attractions why people use it. So we'll see how that plays out and how that comes through into the future. One other question is not necessarily about cryptocurrency, but we start to hear things called NFTs. I'm sure you're familiar. Could you guys give us a minute of what an NFT is and what that means?
Sure. So an NFT is a non-fungible token. And basically what these NFTs are digital assets where the owner owns the asset, right? So I think the easiest way to think about it is, take the Mona Lisa, right? So the Louvre owns the Mona Lisa, but they could create an NFT of the Mona Lisa and sell that to an investor, right? So then somebody would own the digital rights to this digital Mona Lisa. I know it's a little bit crazy to think about. Another way that I've explained it to people, so Topps, for those of us that are my vintage, I grew up collecting baseball cards, basketball cards, hockey cards, so on and so forth. They've begun to develop NFTs that are basically, digital baseball cards. And so I think that that's a really easy way of thinking about it. There's no physical asset that stands behind it. And I think that's where people get a little bit tripped up. But think about owning the rights to a certain picture of a certain player. That in theory has value over time, just like, every time you get in the elevator and you hear the Rolling Stones playing over the speaker, Mick Jagger hears ka-chink in his bank account. So that's the way I think about it. I think some are good, some are a little bit ridiculous. But it's definitely an environment where you're seeing so much growth, and this is true of both NFTs and crypto assets more broadly. You're seeing so much growth, and it's occurring at such a rapid clip that there are bound to be winners and losers, right? You think about Dogecoin, which is based on a meme of a dog. I mean, it's like worthless in my opinion, right? But you think about decentralized finance apps that operate on the blockchain that remove the middlemen, say in a stock transaction. You could say that there's value in that. And so I think the biggest challenge is getting comfortable with the idea that there isn't necessarily physical stuff backing these things, that what used to be the physical asset has effectively been digitized and added to this universe of blockchain, which makes people like my parents' heads spin. But you talk to a first-year analyst at JP Morgan, and they're totally on board. And so it's one of those things where I think over time we'll get more and more comfortable. And frankly, the fact that firms like Sotheby's are very active in the market, I think it lends some credibility to the idea that these assets really do in fact have value.
Okay. Really, again, thank you for your time today. It's been a great presentation. I know our audience has learned a lot about what cryptocurrency is, what the blockchain is, and some pitfalls and things to look for when thinking and considering about adding cryptocurrencies to a long-term investment portfolio. So, David, thanks again for your time, and thanks everyone for joining us. Any specific questions, please contact us along the way, and we'll be happy to speak to you at any point in time. Have a great day, everyone. Thanks for joining us. Take care.
Thanks, everybody.